Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial world and unearth the stories hidden within official reports. Today we are diving deep into a rather complex filing from Daxor Corporation, a company that seems to be walking a tightrope between being an operating company and a registered investment company. This latest filing is basically an update to their registration, and boy does it reveal some interesting layers.
So, what exactly is Daxor Corporation? Well, they describe themselves as an investment company with medical instrumentation and biotechnology operations. Here is where it gets a bit tangled. They are registered as a closed-end investment company, but they insist they've always operated as a business.
Not primarily as an investment firm. They are even planning to file an application to stop being a registered investment company. This immediately tells us they are in a transition, and transitions always come with risks and opportunities.
Their main focus is the BVA-100 blood volume analyzer, a device that measures blood volume used with a special injection kit. They also have a manufacturing facility for this. Sounds like a typical operating company, right? But then they talk about needing earnings from an investment portfolio to fund operations.
This duality is crucial.
Let's look at the financials. For the 6 months ended the 30th of June, 2025, the net asset value per share, which is basically the per-share value of the company's assets minus liabilities, started at $7.25 and ended at $7.15. That is a slight decrease. The year ended the 31st of March.
2025 also saw total income from operations as a negative $0.14 per share. Not exactly a boom. But the market price per share actually went up slightly from $9.6 to $9.79. This suggests investors might be looking past the current operational numbers,
perhaps anticipating future growth, or simply attributing value to their operating business more than their investment portfolio.
Jumping back to the year ended the 31st of December, 2023. The net asset value per share started at $6.75 and ended at $7.08, showing some recovery. But the total investment return for that year was a negative 18.87%. That is a significant drop, meaning if you had invested $1,000, you would have lost about $189 that year. The market price, however,
was more stable, starting at $9.16 and ending at $9.6. This divergence between net asset value and market price often happens with closed-end funds, and it highlights the market sentiment versus the underlying asset value. Now let's talk about costs. For the year ended the 31st of December, 2024, the ratio of total expenses to average net assets was 0.90%. This is quite good, meaning their operating costs relative to their assets are low. However, in 2023, that ratio was 3.32%, and in 2022, it was 5.86%. So, they are doing a much better job at controlling expenses lately. That is definitely a positive sign, especially given their operational focus.
the company emphasizes that they are not primarily an investment company, and their core business is medical instrumentation and biotechnology. This means the risks associated with their operating division are probably more critical than the risks of their investment portfolio.
One of the biggest risk factors mentioned is their planned deregistration as an investment company. If they succeed, investors lose the protections that come with being registered as an investment company. This is a major change, and it could impact the stock's valuation and how it is perceived. They also mentioned that if they get approved to deregister,
They will immediately stop offering shares under this registration statement. They might even have to switch to a different type of registration form. Like any investment involving the stock market, Daxor faces market risks. They rightly point out that the value of investments can go up and down daily, and you could lose money. They specifically mention the volatility caused by things like the coronavirus pandemic, economic concerns, interest rates, and trade tensions.
These global events can shake up any market, so it is smart they are acknowledging them.
Here is a very specific risk. Daxor concentrates its investments in the electric utility industry, with a policy to keep at least 80% of its investment portfolio in electric utility stocks. This is a huge concentration. While utilities can be stable, this means their investment performance is heavily tied to one sector's fortunes. If the utility sector faces challenges, their investment portfolio will likely take a big hit. They do have a provision to lower this to 70% if management thinks it is necessary, which shows some flexibility.
They also engage in short selling as part of an income strategy. and to mitigate risk. Short selling is when you bet that a stock's price will go down. It is a bit like playing with fire because the potential losses can be unlimited. Unlike buying a stock where your loss is capped at what you paid.
They state that their net short position will usually be less than 15% of their portfolio value, which seems like a controlled approach, but it still adds a layer of risk.
This is where their core business lies, and it comes with its own set of challenges. They are at an early stage of commercial development with their BVA -100 device. They have some hospitals using it, but to reach wider adoption, they need more investment in sales, marketing, and convincing the medical community about the benefits through clinical studies. This process can be slow and expensive.
And there is no guarantee of success.
A big red flag here is their need for additional capital to conduct our operations. This is very common for companies in the development phase, but it also means they might have to raise more money through selling more stock, which dilutes existing shareholders, or through debt, which increases financial obligations.
The reporting structure itself is a risk. They report as a closed-end investment fund, but have an operating division. This lack of detailed, segregated reporting for the operating business could confuse investors and harm confidence. They plan to shift to a traditional operating company reporting structure as revenues increase.
But that is still in the future. Intellectual property is key. Their original patents for the BVA -100 expired in 2010. While they have new patents filed and granted, the expiration of foundational patents is always a point to watch. They also mention the patent for their tracer injection kit expired in 2016. Competitors could potentially use this.
Now, let's look at the stock itself. The common stock has been traded since its initial public offering and is on NASDAQ under the symbol DXR. Interestingly, for much of the recent past, the stock is traded at a significant premium, meaning a higher price to its net asset value. For instance, in some quarters, the premium was over 100%.
This suggests a lot of investor confidence or perhaps speculation beyond the immediate asset value. However, the trend shows volatility with premiums fluctuating.
The leadership team looks solid, with Michael Feldschuh as president and CEO, and his brother Jonathan Feldschuh as chief scientific officer. Michael has a deep background in finance, including hedge funds and investment management. Jonathan is instrumental in the company's technology.
It is worth noting, they are brothers and both interested persons due to their employment.
This recurring theme of transitioning away from being a registered investment company is really the central narrative here. It signals a strategic shift towards focusing purely on their operational business. This move could unlock new avenues for growth and investment, but also introduces significant regulatory and market perception changes.
So, what is the final verdict on Daxor Corporation? They are a company in transition, trying to shed its investment company skin to fully embrace its identity as a medical device and biotech firm. The operating business has exciting potential with its BVA -100 device, but it is still in the early stages, requiring significant capital and market acceptance.
The investment portfolio, while providing some funding, carries risks due to its sector concentration and the planned deregistration. The stock's trading at a premium to its net asset value hints at investor optimism, but the dual nature of the company, coupled with the impending regulatory shift, means there is a significant amount of uncertainty. The success hinges on their ability to execute their operational strategy and navigate the complex regulatory landscape. All right. That just about wraps up our deep dive into Daxor Corporation's filing.
What's your take on this company's transition and its future prospects? Let us know your thoughts in the comments below. If you found this analysis valuable, please hit that like button. Subscribe to Corporate Decoder for more of these in-depth looks. And don't forget to join our Discord community linked in the description for more real-time discussions. Thanks for watching.
And we'll see you in the next video.